Good afternoon, everyone. Welcome to our final panel session of day one. It's been a great day so far. So I think we're going to finish very strong with this panel. My name's Chris Morris. I'm the VP Business Development for Ausenco, based out of Brisbane in Australia. Ausenco is a leading engineering, consulting, and project delivery firm supporting the mining industry. And our panel session today is navigating complex mining industry challenges to get projects into production. So I'd like to briefly introduce the panelists who have sat according to the graphic in no way, or my notes, it appears. So we'll start with Mark Selby, current CEO of Canada Nickel, formerly RNC Minerals. Mark served on the board of various junior mining companies. Alex Scanlon, founder and CEO of Barton Gold, financial economist with 20 years experience across both private and public companies, leading investment into the natural resources sector. Marty Tunney, COO of ISO Energy, previously president COO of Consolidated Uranium. Marty is a mining engineer with experience across major and junior mining companies as well as investment banks. Ster, VP of Investment and Financing with Mancha Capital. Emma's over 10 years of experience in metals, mining, and investment with La Mancha, as well as SocGen, and has spent time in Paris, Toronto, Hong Kong, and London. Fantastic. And last but not least, Jonathan Dickson, VP International Corporate Services at OTC Markets. Jonathan's been with OTC for over 6 years, previously spent around 9 years with broking investment management firm Redmayne Bentley. So welcome, panelists. Thank you for being here. So our panel today is going to touch on a couple of key themes, one being capital constraints, permitting and regulatory, community engagement, and technical innovation. So we're going to jump straight in and talk about the capital constraints. And Jonathan, I might throw to you on this first one to kick us off. If we think about where we are now, middle of November, compared to the start of the year, that disconnect between commodity prices, market valuations, is it growing, is it shrinking, or is it commodity specific?
I'd like to think it's shrinking. I think if we take the obvious things away, like supply and demand dynamics, geopolitical, which is very geopolitical the last couple of weeks, things like that, I think we are starting to see a shrinking slowly. Certainly from a US perspective in our market, albeit we're a secondary market, we do tend to see that gap narrowing. Look, there's a long way to go. I don't think there's any doubt about it, but it is a tough dynamic. It's tough to navigate. It's frustrating for particularly good growth stories in the resource space, but I still think there is the ability to navigate that gap, and the capital is available if it's looked for in the proper areas.
And Alex, I mean, you're very gold focused. What's your take?
I actually, my view is you can't separate it from geopolitics. I think whether you're talking about gold or any other physical commodity, the past year in particular has really seen, let's say, the firming and then an opening of the cracks that we're seeing in sort of the deglobalization of supply chains. Everything's been geopoliticized. Depending on where you are, depends on how you will be valued by whom. And I think that we're going to see asset values, company values converging on the underlying product valuation, depending upon their ability to deliver it within, let's say, the most desirable markets, right? And I do think there will be a valuation premium for those who can deliver into the market that they apparently belong to, and a discount for those who might seem a bit of a duck out of water, who might be sitting in the wrong pond in 5 or 10 years.
Yeah, interesting. And what about uranium, Marty?
Much like what Alex was saying, I think that we're seeing a bit of a deglobalization, and I think in uranium there's a bit of a bifurcation of the market, east versus west. And security of supply, I think, is becoming more and more important, more relevant, and I think that's going to really, drive a different price between what we're seeing in particular paid in North America versus what's being paid in the East, and I think the producers that are able to deliver within, for instance, the United States are really going to see a premium from their investors. I think that people are going to say, this is homegrown, we want it here, and it's going to help our country. And I think you're going to see groups like that already have strong access to capital, which I think is a big part of it. If you don't have strong supporters to begin with, it's hard to get additional strong supporters. So having that initial capital is great, and then being in the right jurisdiction can be very helpful.
Yeah. Do you think the mining industry has an image problem? Mark, maybe throw that one to you.
Very much fundamentally an image problem, both in terms of effectively deploying capital, and then unfortunately still in terms of environmental impact. Again, part of the reason investors aren't lining up to put money into mining is because, in terms of generating effective return on capital, been demonstrated we do a very bad job at it, with only a few exceptions. Number two, in terms of environmental impact, again, we should celebrate the wins, and there's lots and lots of things that we do well. Unfortunately, events like the Vale BHP iron ore disaster does nothing to dispel the fact to dispel stories about us having an impact on the environment. So we could do a better job PR wise for sure, and I think we should be.
And maybe just teasing that out a little bit more, we talked about some of the environmental issues, but capital budget blowouts, I mean, is this something that's scaring people away? I mean, Emma, we've talked about this already.
Yes, definitely. I think it's every time a project fails, the market remembers, and it ripples across the whole sector. It doesn't necessarily have to remain an effect on that commodity, but I think maybe just going back to the disconnect between companies looking for capital and perceived valuations from investors, there's always going to be a disconnect. The investors are always probably going to think that the company may be looking for something that's a little bit over its value, and the company's always going to think, oh, but my value is more than what you think. So it's about educating your investors. It's about demonstrating that your project long term has certain characteristics, will withstand the commodity cycles, is low cost, has that resilience and some upside or some other potential. And if you demonstrate that your project or your company has those characteristics, you'll likely bridge the gaps. And it's also about instilling confidence. And back to the CapEx question, I think it's key to avoid tailoring your study to what you think you can achieve in terms of finance. And because just down the line that will come to bite you in the butt. Basically, if you put out a PEA or a feasibility study that's just over optimized, and later on down the line you'll need more capital to finish building the project, then typically that's actually what hurts equity investors the most. It's really, really bad, and it's really, really hard to recover from this kind of scenario. And it's really, really hard to find money at that point in time. So I guess one key thing is to be reasonable when you publish your study, and make sure that
realistic numbers.
Yes.
Yeah. It's possibly human nature that we like to talk about the disaster stories. It's a better conversation than saying, well, this project went pretty well. But I mean, Jonathan, is that part of the image issue? People are focusing on the disasters rather than the projects, the studies that have actually done pretty well.
Yeah, I think that's a really valid point, and Emma makes a really key point there, that we sit in this dichotomy that when we link ESG, for example, when we link CapEx and having an image issue, if you think about industries which have high cash burn, the resource space is a high cash burn. There is a constant demand to need to go back to market for whatever the project is, often, particularly in the junior mining space. But life science, biotech, they have higher cash burns. They don't really have an image problem. The nature is, by virtue of the fact that you've got a hole in the ground, there's this preconceived idea along non-specialist investors that maybe that isn't an area to be in. Maybe there is an ESG concern. So I think if you link all those together, it becomes a bit more of a trickier issue. But no one disagrees that it's a required element of the market.
Yeah. You talked about cash burn. I think that's a really good point. I don't think anyone would argue that it's not getting more expensive for junior companies just to keep the lights on. So maybe Alex, keen to get your view on how big an impact that has on exploration and development spend.
Yeah, look, I mean, I think it is getting more expensive for junior companies to keep the light on. And there's a couple of reasons for that. One is, you've general cost inflation anyway, right? So whether your electricity bill is going up or the cost of your people are going up, these are all sort of, expansionary costs inside. You have increasing regulatory costs. It takes a longer time to do things. Time is the ultimate killer, even if you have a successful project. But I think, the other ultimate issue is something that the industry has tended to do to itself over and over and over again, is subdividing assets into such small blocks that you end up with very inefficient capital structures, heavily multiplied time and time again over small assets, and then costs are inflating in these things. So, periodically we do see, we see periods of, I guess, dispersion and then consolidation. And, my view is we're in a period of time where we were likely to see a lot more consolidation so that people can actually address these things and actually have the critical mass to attract the funding to get over some of these hurdles, and also have optionality between their assets. It's very difficult to start with a single asset small platform with no optionality and be entirely reliant on what anybody else is willing to let you do, because that is also an inflation, right? If you are reliant on what somebody is willing to give you, the price is basically $1 less than bankruptcy, right? So it's the industry needs to reorganize itself, and we need to be better at deploying, using, allocating, and concentrating capital.
Mark, your thoughts?
No, I would echo a number of the comments he said. Again, I'm not sure we're structured in a way to effectively deploy capital as much as possible. The challenge is right now is most investors are very focused on gold, silver, and copper, and uranium sometimes. And so if you're outside of those elements on the periodic table, the available capital drops pretty significantly. And then, realistically, if you're outside those metals, the only way that you're able to get from exploration into a construction decision, which we are now, is strategic investors. So we have three right now, and getting very close on a fourth. So that's really the only place that you can look for capital today to get something to production.
Yeah. And Marty, experiencing anything different in the uranium space, or more of the same?
I think it's largely the same. I think part of the issue is too, we look at, we're all competing for dollars. And there is that tendency, as Emma was saying, to kind of, I guess, overestimate what you're able to deliver on. And I think that's one of the challenges. And people have been burned over and over again. And I think it's, better communication and really being honest about what you can do. Because I think you're more likely to be rewarded in the end for being accurate than you are for, sucking in a few cheaper dollars up front and things getting very expensive and becoming terrible in the end. But I mean, that leaves opportunities for, people out there who can pick up projects that have gone bankrupt, right? I think it's really a communication issue. But in terms, the overall theme about things getting more expensive, part of that I think falls on governments as well. Like there's a lot more. We talk about the regulatory environment, and especially when you talk about small companies, the onus to the reporting onus on small companies and the amount of things that you need to deliver to the government, you start adding on extra bodies that are really not adding any value to the company itself, but they're really becoming an extra body that's delivering information out to the government that seemingly doesn't go anywhere other than to some bureaucrat's desk and doesn't get fed back into anyone else. And that's a mistake. because small companies are out there, the explorers, to put holes in the ground and deliver to their shareholders and meet what is really reasonable and should be delivered to the government and what should be reported on. But when you start asking people to duplicate over and over again those small things that they were doing, it's a pretty inefficient use of capital, and it doesn't lead to a strong economy in the end.
If I make a comparison, say, between mining and tech stocks, mining's obviously significantly more regulated, arguably at a point where a business is still quite speculative. Do you think that regulation should actually be wound back for junior mining companies?
I don't know. Mark looked like he was about to say something, so I might let him
No,
dig
go ahead.
in.
No, you go ahead.
I don't think that there's regulations that should be wound back, but I think the duplication should be wound back. For instance, in Canada, there's an onus to consult with First Nations, which is very important. There's also rules in place that were set up by the government in terms of how you need to consult and what you need to deliver to the government. But the government doesn't actually really enforce their own rules around consultation, and they leave it up to the companies. And it's really kind of a Wild West. It's not clear. That can be costly in the end. And you're really getting no value from the government in terms of what you're forced to pay out to First Nations. And it's benefiting those communities. And these are after-tax dollars that you're expending. The government needs to look internally and say, okay, well, is this something maybe that we should be giving benefit for to these companies that are out there doing the work that the government should be doing? And the same as in the U.S., there's a lot of regulatory agencies that no longer have the capacity to look at projects and evaluate them. So you get you get a phone call and it says, hey, this is going to take us 24 months. Or if you guys want to pay $1 million, it'll take 6 months because we'll hire an outside agency. So again, these are things that the government expects you to do, and taxpayers are paying for, but you're paying for it, and it's duplicative.
Emma, you look like you want to jump in.
I'd like to jump in. Maybe add it, or going one step further, or maybe one step too far. I don't know. My view, at La Mancha, for example, our view is that it's almost safer to invest in West Africa or Brazil than it is to invest in Canada, for some reasons linked to permitting or whatever. And the problem is that maybe North American companies are penalized by this because a lot of investors will think that actually the regulatory environment is so punitive, or will make the companies lose so much time value, because it's, for investors, it's all about how long will it take to get a project into production and producing money and producing value. And if I can invest in a country in Africa where I know the project will be up and running within 18 months, and I look at a project in Canada and it will probably take 3 to 5 years, that's also going to weigh in the balance.
I guess you own it though in the end.
But invest. I mean, maybe I don't know if some of you were here for the last comment of the last panel, and they made a comment when they said that investment cycles should maybe grow a bit longer. Instead of looking at 5 years, maybe you should be looking at 7 plus, just because of this. Yep. But certain funds are set up to work that way. So.
And Marty, I might just jump back to you again. I mean, we've talked a little bit about certainty of execution, access to capital. There's obviously been, ISO has been pretty busy with the consolidated uranium merger, the acquisition of Anfield. What's the rationale there? Is that particularly addressing these issues?
In terms of the consolidation?
So consolidation of assets in one location, de-risking.
It's about all of those things. I mean, we look at companies, we've got luckily very strong backers, so we're able to have very good access to that capital. We look at a lot of opportunities out there where great projects, unfortunately not great access to capital, and maybe fell victim to the overpromise under-deliver, or also in the bad cycle. Uranium had a very long period of where things weren't good, and we were able to just go and pick up, world-class assets for nothing. And I say world-class without, any concern that that's not real. We picked them up for, pennies on the dollar. But we also, along with that, came with, large portfolio of other projects that we've been able to rationalize and put in hands and help support those people financially that can do something with them.
We've talked about capital in the traditional sense, but if I switch gears to human capital, personally, I have a theory that this is the bottleneck that's sitting just below the surface that we haven't really felt yet. Do you agree? And what are you doing to attract and retain those right professionals? Alex? Oh, sorry, Mark, you want to jump in?
Oh, okay. No, we've that's been a focus from us from the beginning. We've made a point to basically get those people in place as early as possible and grab good talent, because it is absolutely the scarcest commodity that's out there. What's been helpful for us, because we have an ability to be a net negative carbon mining operation, and with the downstream being a zero carbon operation, that dimension of it has allowed us to attract a lot of really smart young people who are really attracted to that dimension of it, and so that's been helpful. But going forward, that is going to be the key constraint once the money starts showing up, for sure.
And is retention an issue, or once you have people in the door, they're aligned to the message and you hold
Everybody
on to them?
loves working for us, so
Yeah,
it's not.
I thought you'd say that.
No. It's again, it's something we focus on, because as soon as you take it for granted, then all of a sudden people start, leaving. But so far, we've kept it interesting enough to keep people.
And Alex, from the Australian perspective?
Yeah, look, Australia is an interesting place because obviously we're a giant island, right? So we have a pretty closed circuit when it comes to available labor. But to echo these comments, like we have a very, in our company, a very good, clean, simple capital structure. We're well capitalized. As an explorer developer, we actually generate revenue internally. It's a very unusual model. But we're starting with a large asset platform that we can monetize and do all these things. But all of this taken together, whatever optionality and value we can generate in these assets, all links back to the people that we have, right? Our human capital is by far the most important capital that we have. It is the creativity, it's the relationships, whether that's out there in industry or with the state. So, we think very carefully about who we bring into the team, and we've built a team that looks nothing like your conventional junior developer explorer team. But, on that point, yes, people get more expensive, and Australia is known for having expensive people. But if you do have a platform where you are putting together something special and you can get the right people and show them how they can be a part of that message, we have people come join us and take a discount on what they were earning elsewhere. And that goes to both what we're doing, but you also have to think about more creative strategies to involve your team in sort of the equity upside. But on the flip side of all of this, we have to remember that human capital is mobile, and it votes with its feet, and it goes as almost as fluidly as actual financial capital goes. So the question is probably not, is it the bottleneck? It's just the question of can you afford to make sure that you're able to actually maintain that, because time is the enemy, and as you're carrying that cost, you need to, as our other guests to the right are saying, is you need to be able to accelerate quickly through these gates to make sure that you don't have to fund too expensive a cost for too long to actually acquire this really high quality capital.
And Jonathan, do you think if we see this further increase in M&A activity, is that going to ease this problem a little bit?
I don't know, because sometimes M&A can be a negative, and it can be a significant negative. It can create a downward spiral if it's not done in the right environment. In part of the cycle, when you're looking at M&A and you see these opportunities to pick off smaller organizations, smaller companies with good assets, you've got to get the timing right. And I think you can structure the deals, you can get the financing in place, but if it's the wrong part of the cycle, I think that can also be an issue. But I don't see why not going into the next 6 months, why we won't see an uptick in more M&As. Let's hope and let's see if we start to see more money flow back into the system.
I'd be tempted to make a comment about getting more kids into STEM subjects, but I suspect that's an entirely different panel for another day. We might keep moving and jump into permitting and sort of regulatory. Again, maybe an assumption, but I'm going to say in most jurisdictions we're seeing a disconnect between the political messaging, which sort of talks about securing critical metal supply, decreasing dependency on China, emissions targets, and then the I suppose the legislation and policy that supports that. Is there a feeling that the government wants, in multiple jurisdictions, the mining industry to be successful, but there's no actual skin in the game? Mark, I can see you just raring to go on this one. So.
Yeah, so, I mean, to Emma's point earlier, Canada historically has been pretty challenging. We're lucky our team permitted a big project last decade, and we're permitting a project this decade. And I can tell you, actually, there has been a real shift in the government attitude, towards permitting. Before it was basically, we'll keep asking you questions and pushing it until there's no more questions asked, and then we'll be basically, okay, we'll have to give you your permit because we've run out of questions. Right now, it's a much more collaborative process, and they are actually focused on getting you to the goal line. So in Ontario and Canada, we've taken our project from 5th drill hole to next week we'll be completing the second stage of the federal permitting process, and we expect to have our permits in less than a year from now. And so, that shift is happening in some jurisdictions. Unfortunately, not all jurisdictions.
And you actually secured a grant through the Canadian Critical Minerals Infrastructure Fund.
Yep.
Reflections on that process?
Yeah, it was way longer. We have $4 million out of a tranche, so it's a $1.5 billion fund. There was about, I think, $100 million or $200 million tranche for studies for infrastructure, and so it was great. We have $4 million to do the engineering studies on some of the infrastructure for the project. The good read through for that is, that should put us in line for free money to actually build the infrastructure when that comes. So fingers crossed that's there. So that money's there. The one thing I think investors should realize is, the government has set up these refundable tax credits. For us, because we have our carbon capture as well as the critical minerals element of it, we qualify for over $600 million of free government money. And now it's sitting out there, and it is there. The law is in place, and we qualify for it. And we've been encouraging the government to actually state that publicly, just to make it very clear to investors that money is there. So they are deploying capital. I think you're going to see more capital come into the space over the next 12 months, because it really did take them to your talent point. There's, when the government announced all these programs, it's great, but they need to put the policies in place and they need to staff up to do it. And that's taken them probably 12 to 18 months to get there. But I would say the people are in place, the policies are in place, the processes are in place. Still go slower than you'd like, but I think over the next 12 months, you'll see more and more capital start to flow out of governments at every level.
And Alex, from a sort of Australian perspective, there's been a couple of high-profile projects that have got quite far through the permitting process only to have applications pulled. What's your take on dealing, in South Australia and at federal level?
Yeah, obviously there's been some pretty high-profile problems there, and in terms of, we're talking about Regis Resources getting their McPhillamys permit effectively overturned by the very office that granted it, right? So this has been quite a scandal in Australia, and to be frank, I don't think anyone expects that ministry to be under that leadership for much longer. It's been quite a scandal, but yeah, I think going back kind of to the original question, one of the challenges that every jurisdiction faces is cost inflation in people, right? And when we are talking about, cost of human capital is going up, salaries inflating are drawing people away from government very, very quickly. It's making it very difficult for government to actually compete, to get highly experienced technical people into these roles. So there is certainly a convergence on the understanding that the government needs to play an active role in creating supply and access to these minerals. They know they need to do it. They know they need to throw money at it, but they're not exactly sure where to throw the money because they're lacking the people to choose very carefully. So that's probably, in my view, the greatest weakness in the whole strategy. They are at the table, but they're not quite sure how to play. And then that is leading to a whole lot of sort of inefficiencies. It's moving along, but they need to be able to spend more money to retain people. And that is really the biggest challenge to everything in Australia, and I'm sure probably in all other jurisdictions.
Yeah. I think, Emma, you sort of alluded to this a little bit earlier, but are certain jurisdictions that maybe were once favorable slipping down the pecking order, or indeed parts of the developing world are actually climbing up and becoming more attractive in your view?
Well, I think it's easier when you're looking at a project in Africa to make sure that the government wants the project to be taken off the ground because of the amount of tax, royalties, employment, local contracting. So when you're looking at a project in a developing country, you're pretty sure the government will want the project to exist. When you're looking at North America, Australia, or Europe, you're not as sure, and it's not just because of the government might not put in place the framework or the help or the subsidies to make sure the project is economic enough or will be attractive enough to investors, but it's also you're not sure that the local communities, and maybe you'll get to that point later, but you're worried about like how long and difficult will be conversations with First Nations or just local retirees sort of in the countryside of England, so, who happen to have bought a house in Cornwall and don't want a mining project there. So I think from an investor's standpoint, there's clearly more wariness in terms of putting money into projects that are in the developed part of the world.
I think I might just make an add to that. And this is just an observation as our market over the last 6 or 7 years, which we're way overweight in the resource space. But as an observation, what we have noticed is, so we obviously we're sector agnostic, so we have companies from all different types of sectors. Historically, and I mentioned the analogy earlier, the life science biotech space, that's always been a sticking point because if a company's going through phases and looking for FDA approval, it's drawn out, it's a long time. It's actually switched to resource. The amount of conversations we have now with the C-suite at junior miners, companies looking to get ahead, it's this hurdle, it's the next hurdle. There's always the financing level that always comes around, but it's the how do we get to the next stage, which is ironic because the life science sector is hideously regulated, rightly so in many ways, but it's just a stumbling point. So I thought that might be a good observation that we see.
Yeah, and I've heard this sort of comment anecdotally before, particularly with very, very junior companies, that part of the difficulty they have around dealing with government is they don't have the skills themselves, and it's very quick and easy to put the blame on the government. I mean, Alex, have you heard the same stories? Do you agree, or do you think? Where do you see the main bottleneck lying?
In terms of engagement with the government and maybe the government department not having the skills? Or?
Well, also, so very small companies maybe are not fully prepared. You've got a CEO who's wearing many hats on a day-to-day basis, and this is one.
Yeah, well, I mean, I'll be really honest. My view is your problem, dude. You decided to do this. You didn't know what you were doing. You weren't prepared. You go in the door, nothing happens. That's on you, right? So I think that really goes to this question of are too many people creating like these little tiny companies that have no basis to actually get traction? And I think that's where you get the majority of these complaints. It's a lot of people complain about how difficult this market is, or how difficult that market is, or how bad this process is. And the simple fact is they didn't have the capital, they didn't do the work, they didn't prepare themselves, and then they complain about it. So, the bigger question is when you show up at the table and you're ready to go, you've got your information, you've done your work, are you talking to a competent individual who is motivated, who has an incentive to get this done, not only for the benefit of, you hope for your benefit, your shareholders, but for the benefit of the state, right? And that does require somebody who understands how things get done, and they're properly incentivized. And there is often a disconnect there, right? So we have to be honest about that. Look, really the problem is on both sides of the table. Right? This is an industry that attracts way too many people who have no idea what they're doing, and you get these problems, and a huge amount of capital gets destroyed. And it's a common thread in every single answer we've heard here is, it's an industry with a bad performance record. No, it's an industry of distributing capital far too broadly and far too inefficiently and not returning it to shareholders. It's an industry of people putting $500 million into drill holes with no reasonable expectation they're ever going to get any of that out, but they keep doing that, hoping, praying that someone's going to be foolish enough to buy them out. So I think the problem is we're looking at too many crisscrossing inefficiencies and bad decisions, and then trying to blame it, assign blame on one side of the table or the other. It's just so many things. The simple fact is, if more people who are more credible and serious, had more business doing what we do, were involved, you would find a lot more developments happening a lot faster, and in governments that were far less nervous about giving people permissions.
Mark,
that's a great point. I mean, a big part of the reason we've been able to go so quickly is we've got a team that's, done big projects before, and so, so when people complain permitting takes too long, some of it is because they do all this resource work, and then all of a sudden they decide they want to start thinking about permits, and they go to apply for permits, and they haven't done any baseline studies, and they have to have 3 years of baseline studies, right? So it's that development mindset and having the experience to know that, okay, if I'm really focused on taking this project, into development, then I need to start doing all these activities, in sequence, and having that information available. And again, part of regulators, if they're confident that the team is doing the right work, with the right approach, then that gives them the confidence to move more quickly, right? And so, I think that's been a big secret of our success, is having a team that's experienced, doing those activities.
So
the guard is not up when you walk into the office,
100%.
right? You are not fighting your way through 4 doors just to sit at the table.
Yes.
That's a big difference.
They pick up the phone.
which links back to having the right team, which is around that human capital aspect.
I think there's also, again, talking from a capital markets perspective, there's a public versus private element here. There's a lot of companies out there that should not be public. I know that's counterintuitive speaking as the market, but they shouldn't. They're in no position to do so. They're not qualified, to your point. And that is a reputational issue for the industry. And that does come about more often than not. So just as we see that.
Yeah.
The flip side is you don't need to be an eagle to look good. You can be a pigeon in a crowd of turkeys and look pretty good. So it's
That's a great analogy.
but it's true, yeah.
Okay, we might move into the community engagement piece. So gaining and retaining community support has always been a pretty critical aspect. Do you feel like the rules have changed? Is it, is the scrutiny and the expectation higher, Mark?
Oh, 110%. Today, every mining company needs to, again, if you want to be successful advancing your project, you need to start with the concept that, on day one, I communicate to the local communities and First Nations, and want their sort of free form, informed consent to do what I want to do on that property, and that they've got some view in terms of what it is that we're going to do. And again, if you start with that approach and build that trust very early on, then again, everything can move more quickly through. Again, I think some people just try and do the minimum so I can get my permit approved, and then I'll deal with that stuff after, because it takes too much time. But it's time well invested up front. And in today's world, again, versus even just 5 or 10 years ago, that particularly in First Nations in Canada, that free and informed consent is 100% front and center, and woe to you if you choose to ignore that at any point in time. So,
and Marty, do you think companies are getting better at knowing what best practice looks like, or are they learning that on the run?
I think it goes back to the point that Mark and Alex were saying that depends who the team is, right? If you have the right team in place, that they will. There's a lot of, I still hear it with guys out there that want to operate like it's 1981, and they want to go at it the hard way. And the hard way is, you're going to be ramming your head into a wall, and the door's going to get shut pretty quick, right? Like, it's just, you're not going to get anywhere. So you got to get out there early, and I think the smart teams have picked up the people that understand it, and they're able to move forward.
And which applies more pressure, the community in which you're operating, or people, the external perspective of how you're engaging with that community?
The community ultimately they can keep you out if they want. Like, that's the way it is now. And I mean, we've picked up projects where, these, again, as I was saying, world-class asset. Someone went in with a hard head and thought they knew better, and ultimately lost a company that probably was multi-$100 million market cap in the last cycle, and that asset on its own would easily carry probably double that today, but it's going to take years of repairing something that if somebody had acted prudently 10 years ago, it would already be mined.
Yeah. Mark?
Yeah, no, there's a guy I was fortunate to work with my last company. He was a Falcon Bridge greenfield geologist in his past, so went to a bunch of different places all around the world, and had the recipe, and it is 100% the community. And the way you keep out the NGOs is to build that base with the local community, because they'll fly in from wherever, because most of the NGOs don't live in the community where the mine's actually going to occur. They're looking for a wedge issue that they can come in and drive a portion of the community against the project. If they don't hear of any wedge issue, if they don't have a group of people who seem to be upset about the project, they don't show up.
They don't have a lawfare sponsor?
Yep.
No, they won't even show up. I mean,
Yep.
Yeah, the thing to remember here is everybody can argue about whether things are good or bad, or too much or too little, but the most powerful word you have in any negotiation is no. He who holds the power of no controls the conversation. These communities can say no, and that is it. You are done. It's over. When we went we're in the central Gawler Craton of South Australia, right in the middle of the state, across the highway from all the IOCG assets that BHP owns. And we are lucky that huge areas of this region are covered by a relatively small number of groups. So before we even went into this area and bought these assets, and we've consolidated essentially the whole gold district, the first people we talked to were all the native title partners. They were the very first people we talked to. And then we talked to defense, because one of our assets is in a defense protected region. And then we started talking to the pastoralists and people in the state government. By the time we went to the state government, we said we have everybody on our side. They want to work with us. And now we have, we started with native title mining. We started the whole thing with native title agreements over 1.25 million acres of property. And we have this very productive relationship. We bring them along on everything, even things we don't need to invite them along on, things we don't need signed off on. But we have this incredibly productive relationship to the point where if we need to drill somewhere and we don't necessarily have time to go do a full site visit, I can get a drilling approval by phone. And the value of that relationship is priceless. It really, really is important. And I think, as you say, woe betide the person who does not take seriously the fact that, quite rightly, things have changed since the early 1980s. So.
And Emma, from your perspective, when you're looking at an asset and a team to invest in, is this becoming more critical in your assessment, the approach to community engagement?
Yes, definitely. And I think that's one of the first gatekeeping items we look at is there existing issues? What is the management doing? Or if there are existing issues, and it's already a pretty orange flag. But if there are maybe some questions or even issues with NGOs, not necessarily the local communities, then yes, is there presence in the country? What is the company doing to try and address and repair the relationship? As Alex was saying, it's really hard to repair the relationship if it's been broken. It's not undoable, but it probably will take a long time. But yes, definitely assessing the state of the relationship with the local communities is a key gatekeeping item.
I think, Alex, you talked about the power of no, and it almost makes it sound like a very transactional relationship. But Have the demands changed from communities? I mean, we go beyond the stereotypical sponsoring the local sports team. How people want to be engaged, where they're looking for you to engage. Is that changed?
Yeah, look, what I would say is where you've seen it get more expensive is where people have gone with the wrong approach. If you try to kick the door in, people are going to be very defensive and they're going to make you pay to come through the door, quite literally. So, I think, we have seen, without being overly specific, in our region, again, there are a few different groups, and we are very intimately familiar with what the style of agreements have been in the past and how they've been evolving in the future. And one of the first things we did when we went to these groups, we said, look, traditionally you've been governed by this type of ILUA agreement. It was sort of a state-sanctioned automatic agreement that could govern the relationships. We said, are you happy with that? Do you want us to customize an agreement so you're sure that your specific concerns are covered? Mm-hmm. And we're still all playing broadly within a space that, we're all comfortable with. And almost all of them said yes, right? So we took an approach of basically saying, tell us your issues to begin with. And that has, I guess in some respects, paid dividends, and we're all operating very happily together. We have seen people go in and sort of just say, even relying on, an historical agreement, well, I'm allowed to do this. So I'm telling you what I'm going to do, and if you don't like it, blah. That backfires. It backfires a lot. And then what happens is when the conversation comes up to go do a clearance survey, renegotiate rates, you find that the rates that those parties are paying are $1,000 per hour per person for a survey instead of $500 per person per day. So you will see a bifurcation, and it will often come down to the quality and style of engagement right off the bat. These are your partners. Like it or not, these are your partners. If you treat them like partners, you're going to have a much better go of it.
I think there's an increasing number of consultants and advisory services in this space now. If you're a very small company, do you see value in getting that advice coming in externally, or is it something that's better driven from home base? Maybe stick with you, Alex, from an Australian perspective first.
Yeah, look, the quick answer for me on that one is yes. Look, we sought out pretty directly people that we knew had long working relationships with these parties, because these consultants tend to be regionally specialized. I would say, be wary of somebody who just claims to be the master of everything. Every single one of these, native title groups or traditional owner groups, they all have specific sensitivities. Inside of their corporations, there might be 4 or 5 families that all have their own specific sensitivities. So, a consultant who is, locally knowledgeable and very aware of these things is worth their weight in gold and saves you a lot of time and trouble. And they know all the agreements. They know all the terms. They can help you navigate it, and they can help you get around problems that you may not even know you have, and help you just say, look, that's not even an issue. I've got that sorted.
Okay. Marty, your thoughts?
No, I think he nailed it. I mean, you have to go in where there's already, you have to go in with the right people, I think. And, there can be a challenge in finding, because there's a lot of groups out there that will claim to be able to help you. You go into a new place and everybody has their hand up and claiming that they're going to be the one to get you what you need. And I think it partially also goes back to what he was saying about, if you've gone to a place where someone tried to kick the door down, that's the hardest place to go. You go to a place that's new and green, that's also pretty hard. But, it's easier. If you go to a place where, it's happened before, it's clear that it's happened before and people have been successful, the community's done well, that's probably the easiest place to go. And, you want to seek out the people that have been part of that, which is, again, what he was saying, because they'll know exactly how to get it done. And I think that's what you have to do. And if you've got, a broad enough network, you'll be able to figure out who those people are. Otherwise, it's going to be tough learning through experience. And if you don't have the network, you probably shouldn't be running the company and doing these things.
Okay. We're going to switch gear again and look at technical innovation. I think we're not seeing large volume, high grade, easy to extract projects, emerging all over the world at the moment. We're increasingly working with more challenging assets with these inflationary cost pressures. Is there a broad understanding within the industry that we need to start innovating, we need to start challenging ourselves, or is that still emerging? People want to do what they've done before. Mark?
Yeah, with investors, absolutely. no recognition that that's the case. Just talking specifically about nickel, nickel investors were used to, the prior generation of nickel companies generally had high-grade underground operations, and that's what they know, and that's what a nickel deposit looks like. The reality is, we haven't found a nickel deposit that's high-grade that has more than 1 million tons of nickel since Voisey's Bay in 1992. And nickel's now a 3 million ton per annum market. So these big low-grade ultramafics that we've been focused on, as someone who's been in the nickel industry 20 years, these have to be the new source of nickel that's required going forward if we want nickel from somewhere other than Indonesia. It's so hard to get investors to think about a new type of deposit. Well, the recovery is only 40%. Well, in tight oil and gas, you only recover 10 to 15% from a reservoir. And there's lots of cases, it's just different. So, that makes it very hard. And then, again, finding funding, for innovation is equally challenging, unfortunately, right? And we need it. Like, we absolutely need it up and down. So,
Marty?
Yeah, I mean, we've got the highest grade uranium deposit in the world in the Athabasca Basin. It's 2 orders of magnitude higher than what's normal, grade globally, or what is considered high grade globally. So looking at that, that presents challenges unto itself. So there are some novel techniques that are being developed. Certainly, I think investors would prefer to go the tried and true method because it's what's normal. But in some cases, I think if you've got an exceptional ore body that probably has a bit of room for correction when you're going in there and beyond what you expect, I think you can get the backing of the market to go and do it. And depending on the what you're going to get on a margin for a ton of ore. I mean, when I was in the gold space, a few $100s per ton, and when you're looking at $60,000, $70,000, $80,000 a ton rock. Like you've got a bit of margin of error. So,
how receptive are we as an industry to novel technology? I mean, I often think we're in a race for second place. So we want someone else to do the hard yards, prove it out, try it, test it, and then we'll be next in the queue. I guess maybe, Emma, from your perspective, what's that balance between risk reward?
Yeah. So maybe in the defense of the investor, you're asking the investor to agree to project on project risk, basically, or technology over project risk. So you're compounding your risk. It's a very, very specific kind of investor who's agreeable to this and will be looking for very high returns as a result. So you're looking at a rare fish.
Mark?
Right, but again, I think the counter to that is, when you take away, we're in Timmins in Canada, so the political risk is zero versus West Africa. There's going to be no military coup to take over the country. Number two, you're using, proven, it's an open pit mine, right? And so, the geology of the ore body is broadly disseminated, so there's no geological risk in terms of the ore body, and then, the team, should be able to do the additional amount of work to be able to de-risk it enough so that it's, you minimize that compounding impact. And again, you have some offsetting risk. So net, it shouldn't be a giant leap. So that's the...
No, I agree and I understand. I think maybe one thing that's lower hanging fruit that companies can be pursuing, which doesn't add project on project risk, is more sort of productivity or effectiveness at the margin, and that's something that's really valuable for investors. And maybe the one technology I think that investors are really excited about, and that can be industry changing, is probably the use of big data and AI in geology and exploration, because falling grades, etc., and that is probably going to be something that will help the industry as a whole to overcome that issue.
Yeah, no, I think, again, in terms of the race for second, one of the things that has been good, we're going to be designing an operation But given the timing of it, that will be full trolley, and then battery electric vehicles. That's when the big companies are planning to have it. We're planning the site to be completely autonomous, and so because we're sort of choosing to be closer to the front of the queue, even though we're a small company, we're getting very we were able to go behind the curtain at Caterpillar. Rio Tinto went first, and we got to go second, right? So there are opportunities where you are because I know the vendors are so keen because again they've got all kinds of new technologies. They'd love to find a place to do it. So again, in the right way, in the right place, those opportunities are there to take advantage of.
And that's maybe a good segue to what are some of those emerging technologies that are, you can see them being readily adopted. They make a material difference to sort of de-risk or add value. And I guess to your point, Emma, they straddle that balance of not too much risk, a good amount of reward. I mean, Alex, what do you see?
Yeah, look, we are a little bit unusual, and taking Emma's points quite rightly. It's this is already a very high capital risk industry. So when you're sort of saying, hey, I want to go try something creative to maybe be able to enhance my exploration, you're going, whoa, wait a minute, like let's not just go throwing money everywhere. But so one thing, this goes back to what is the role of governments in all of this? If government wants to ultimately open up more deposits, they need to help people find them more efficiently and help people mine them more efficiently. So it's the unit cost of discovery and the unit cost of commercialization. But we actually have taken the approach of sort of setting up. We run an R&D channel inside of our business adjacent to our exploration stuff, and we've been very good at getting government sponsorship alongside that, both in terms of state and federal sponsorship. So this generates actually kind of a return or recycling of capital for us. But one of the things that we do, one of the technologies we have adopted, and we've tried many, and probably I'd say 60-70% of them, we find an efficiency gain that we can then apply to future exploration. And what's happened is we have seen, as we've done this, our cost of exploration, all-in cost per drill meter going down, and our all-in cost discovery going down. And some things really are cheap opportunities for game-changing technology. And at risk of promoting one of them right now, there's a company called Portable PPB, Simon Bolster's company, right? And so this is a technology spun out of CSIRO, and the idea was being able to basically partially leach, concentrate, and then use in field a handheld XRF gun to actually XRF for gold and to a lesser degree silver, depending on whatever byproducts you have there. Now, this is something that they managed to tune tightly enough that we said we can take the risk of trialing this in field. We had a co-sponsorship with the government, and what has happened is we've been able to validate that this technology, at least on a binary basis, can tell us yes or no, this is an interesting meter. So within 48 hours of drilling a meter, we know whether or not that's an interesting meter. We know whether we should, or importantly, should not be sending it all the way into the lab to be surveyed. And we're also able to reposition. We're literally repositioning drilling programs on the fly and drilling onto mineralization. So it's a very virtuous feedback loop. And what we've actually dropped our exploration cost per meter by about 30%, and we were already competitive in the Australian market. So there are some things, and this is fundamentally a very cheap technology. So there are some things that I think are really worth leaning into, but you have to be able to assess which have merit, how can you validate them cheaply, and which of them are magic beans and black boxes that could be just total smoke.
Yeah.
And most of them are.
Yeah, okay. Marty, what's on your radar, either for your projects or otherwise in the industry?
Generally, or
in terms of these emerging technologies?
We've been using this exploration tool called ambient noise tomography, ANT, and it's really helped us, hone in the basin where it's, typically uranium deposits have been very challenging to drill for, especially when they're at depth and there's nothing really at surface to help you recognize that they might be there. And we found, and we put some money into this. Based on some studies that have been done by others, but we found that it really lines up well, what the feedback we're getting with the mineralization, and it's been very useful for us in cutting back, wasted drill holes. And we're starting to apply that. We were applying it mainly in the basin. We've started to apply that around our projects in Nevada as well, and in Utah. And we found also there we're getting the same type of feedback, and also at our project in Matouche in Quebec. It's been quite helpful.
Yeah, very good. I think we touched a little bit on execution risk right at the start. I'll maybe round out with that. We've heard the anecdotes about the projects that have been disastrous. What strategies are companies employing to try and limit their exposure? Are they pushing a lot of that risk onto contractors and engineers, or is it more of a pain share, gain share approach? Mark?
Yeah, you absolutely have to have a strong in-house team, to manage. That's when you give the keys to the engineering firm. You think you're going to get a Chevy, and then all of a sudden a Ferrari rolls up, right? With a few extra change orders.
With a Hyundai engine.
Yeah, exactly. That's right. No, I think building a very strong team in place. Again, I think choosing the right contractor. I mean, the reason we've worked with Ausenco, for the last 15 years is you guys think like owners. In any time you go into a design question, it's how do we do this for the lowest effective cost, and then B, how are you going to operate that asset when it's built? And the fact that you guys also do turnkey operations, which a lot of people are afraid of, which means given the chance you might want to build it, the feasibility study comes up with a credible estimate, and so it and then again having the guys on our side of the house that can work effectively with you has been a great combination.
Yeah. Okay. Marty?
No, I mean, I don't know. I think having the right team for sure in place. We're just getting to the point now where we're starting to advance some of our projects through that level. And I think having that team in place for exactly that reason, where there's that old meme, or it used to be a poster where it was like contract and it was like a dinghy, and then change order was the yacht. You have to know what you're getting into. There's a lot of projects out there that they look good on paper, and that's the only place they're ever going to look good. And so you also do have to bring in that right firm to work with you, and I think that's an important piece of the puzzle as well, because not everyone's going to be an engineering firm, and you can't have an engineering firm in-house unless you're a super major.
Yep.
So it's the right balance.
Alex, you're maybe a couple of stages away from this from a Barton perspective, but you have a view?
Yeah, look, I actually think it comes down to, and these things all tie together, but your approach really matters here, right? So one of the things about having the right people in the room at the right time also means having, if you're talking about external consultants, getting the expertise, future processing expertise in even up front when you're looking at your exploration models, because there's a very big difference between finding mineralization and finding economic mineralization, and understanding what you're looking at when you're looking at your geotechnical data, your metallurgical data. When you're running early tests, that you can actually start testing your process chemistry just from drilling samples. You can start feeding in future production decisions into the types of project generative decisions you're making. So those types of things are really important, and fundamentally it comes down to de-risking the future pathway, right? So one of the things I always explain, what we talk about internally is sort of a corporate philosophy, which I explain to a lot of our investors, is we're not aiming at some huge giant swing that if we hit it, it's this giant payoff, but it's super risky. We're not, instead of cranking the volume knob to 100 and having a 2% chance of success, we're aiming at something that is an attractive and achievable objective. And then our focus at every single step along the way is, maybe with a little bit of innovation, but a lot of creative thinking and trade-off analysis. How do we go around slicing risk off the side of everything? How do we just de-risk all of these things? And fundamentally speaking, from a mathematical standpoint, what you're talking about is increasing the probability of success. You are far more likely to get there. You are far more likely to have a far more profitable, successful outcome, and you're going to spend less money along the way if you're actually investing in this line of thought along the way. So it costs a little more up front, takes more work, but you're going to be more successfully, and more likely. So,
yeah. Jonathan, Emma, anything you wanted to add before we wrap up?
Yes. So some of you may be familiar with the Horizonte. That was a nickel project in which La Mancha was invested. That went bankrupt halfway, or not even halfway throughout construction. So I have a lot of lessons learned from a project execution perspective. I think I'll share a few with you now, and I think the first one comes down to the team, and this is the most important one, and that has already been mentioned by my colleagues here. But having the right people in the room, the right management team, but also the right people on the board, and treat your board not like a rubber stamp, but actually like what the board should be, which is a gatekeeping, have people with adequate skills, but also have in mind the fact that your project is moving forward, and therefore the skills, the mix of skills that you need at the management level, on the board, and then at a local level changes over time. So it's very important to make sure that the right people are around the table and can check your progress. Then another thing that ties on with that is have a culture of accountability and responsibility throughout the development of your project. So make sure that there's some kind of link between the people who do your earlier stage studies, later stage studies, and then who's going to actually build it, because it's very easy to then end up with finger pointing and, oh, this guy actually, optimized the study too much and now we're missing 500 million. So that's something that really needs to be at the forefront, and that it goes back to being fair in your capex estimates from the start, not sort of over promoting and just so that you can get your funding in place, because later on you may end up with a big problem. And governance also means having the right is project management 101, but having the right systems in place, having the right checks in place, make sure that budget can't just be reallocated from this to that by one individual, and make sure that if there are any big deviations to your order, the right people are alerted to it, because changes to equipment, major equipment, should be a big red flag halfway through your project construction. So I guess those are the basics, but people, very experienced people around the table, very experienced stakeholders may still overlook. So that's I think that's some key learnings. And back to the contractor structure, also try and avoid very complex contracting structures. And if you must have a lot of contractors, then you have to have a sort of control tower system where you can have those checks and balances and someone with a global view, because otherwise people just sort of go off and do things that don't necessarily make sense. Or that's some learnings there.
Yeah, that's really good insight. I think
my question to every year, the union mining sector have a low equities. Is that the discovery going down every year? Is there not that many quality projects are available to fund a more discovery? Because lots of young investors not investing into this industry anymore compared to any other sectors.
quite a broad question, but would anyone like to give some thoughts? Mark?
Yeah, unfortunately, we've been in a 15-year down cycle.
Yeah.
One has been the big movement towards passive versus active money, and so that passive money doesn't reach down into our section of the market cap table. Yeah. There was an infographic floating around the social media. London funds 2012, I think, was 28 billion. Today it's 12. Toronto was 12 and down to 4. Yeah. And so, there's a lot less money entering the space. Again, we haven't had, it's been a long time since we've had a big upcycle where there's been a bunch of winners and, quote, people have made a lot of money. And so, I think we're right on the verge of it. This next critical minerals wave that is coming with a lot of government funding providing free leverage to equity holders is going to create some winners in 12 to 24 months. But I think we've got another 12 to 24 months to tough it out.
Thank you, panelists. Really appreciate the input.